Welcome to Annuity News Now. If you look at the recent numbers, indexed annuity sales are excelling in what is most often looked at as a low interest rate environment. Why is this happening? This doesn't seem to make sense. My guest is Kim O'Brien. She's the president and CEO of the National Association of Fixed Annuities, affectionately known as NAFA. Kim, welcome back.
Thank you, Scott. Pleasure to be here.
All right, so we're talking about fixed index products, which again are tied to the equity markets in some way. Why are you seeing these products in particular doing so well in an environment that annuities should have more problems in?
Well, they're not tied to the equity markets. Their interest rate is developed based on some movement in an index. Usually the S&P is the one that's most moved. But at the heart of it is they are insurance products,
right,
with very strong guarantees. And I think those guarantees are what are driving people to the fixed indexed annuity. It's the two wonderful things about it, which is the guaranteed floor that you'll never lose money due to market declines, and you could earn a little additional interest, probably a little bit more than you might in a CD or a regular straight fixed that are paying a little lower interest rates these days because of the bond market. And secondly, I think it's the GLWBs, the guaranteed lifetime withdrawal benefit riders that are on these products. And I think people are seeing that as a very strong benefit with the insurance element and the guaranteed income you can't lose or you can't outlive. Is a very strong component to the sales figures.
The Obama administration has really given them sort of a nod, and do you think that, it's happening fairly quickly, that people are going to look at these products as a more usable tool in their retirement, on a regular basis? Because it seems like for some reason annuities get a bad rap sometimes, and a lot of that, I'm thinking, is because they're misunderstood.
I think that's definitely true. There's a lot of misinformation out there, Scott. NAFA is spearheading a new 501c3 organization called SAFE, the Society for Annuity Facts and Education, which is going to be directed straight at the consumer and at the media to help clear up some of these confusions. But I think you're exactly right that the current administration is putting a very favorable tone out there for annuities, and we're seeing a lot of activity with the Treasury and their longevity annuities proposal, which will relieve some of the RMD requirements on qualified contracts. A lot of movement in the 401k business because of the pension plans going south, and or the defined contributions matching going south. The 401k annuity is really becoming a strong piece of the retirement planning marketplace.
Which is good news. Now, all these things that make them more attractive also inherently make them a little bit more complex. Do you see as time goes on that these might become more user-friendly, not only for consumers but also for advisors?
Well, we don't concede that they're overly complex. At the base, it's an insurance contract. We don't think it's any more complex than life insurance, than a mortgage, than it is an insurance contract, so by its nature and because of regulatory requirements, you do have to meet certain non-forfeiture standards, blah, blah, blah. So in the core of the product, there's complexity, but all the consumer really needs to understand is three things: guaranteed income,
right,
guaranteed floor, and minimum guarantee interest rate if the market doesn't improve enough to give them additional interest. And
those aspects are really attractive right now, considering how volatile things are in other places.
Very, very attractive. There's so much uncertainty out there right now. We're also seeing the lowest level of securities owned by Americans that we've seen since the early 60s. Only 54% of households, by a new study, still own securities, and that's an all-time low since 1960. So we're just seeing flight to safety as a main motivator for folks right now.
Now, again, in these indexed annuity products are gaining in popularity and doing well. There are other annuity products that are having some problems. As a matter of fact, in an environment when there's probably an outcry for these types of products because of the volatility, you're seeing companies like Hartford pulling out. Can you talk about that a little bit?
Well, I can't talk too much about it, but Hartford pulled out of the variable market, and we're a fixed annuity association, so we don't really comment too much on the variable side. But the variable, the guaranteed with lifetime withdrawal benefits that were on the variable product, we're having a lot of difficulty for the insurance companies to support the guarantees because of the variability in the contract. And so they did not pull out of any of our fixed products. They pulled out of a variable product.
Mm-hmm. And so as you look into the future, I don't know if you can, see in your crystal ball about interest rates. I don't see anything happening, in a big way anytime soon. What do you think is in store for the industry as we go along here?
Well, we think this is a fixed annuity tsunami that's going to happen, driven by demographics. Also driven by the action by the current administration and all the activities in Congress regarding retirement savings, since Americans are so retirement poor at this point. They need protection. They need the product. The income annuity, the immediate annuity, the SPIAs, now they're called income annuities. We saw their greatest market share increase ever as well. So the only fixed annuity that didn't see a sales increase was the what we call the traditional, or the MIGAs, the multi-year guarantee products, and that's really reflective of the real flat bond market we've been having, and as you say, the low interest rate. But with these guaranteed lifetime benefit withdrawal benefits on the index, and with the income annuities, people needing guaranteed lifetime income, we see it fixed annuities really hitting their stride in the next 10 years.
Finally, what does this mean for the advisor out there?
I don't know if you read, Scott, but I read investment news a lot because it's very helpful information. And what it means for the advisors is you have to start having the annuity conversation. I see all these stories where there was an interesting story on General Motors and all the folks that they had an option to take a guaranteed pension in a lump sum annuity or a lifetime annuity payout. And none of the advisors were talking about the annuity solution to those GM Motor people. They were saying they're caught between a rock and a hard place. Do they take the lump sum right now, or do they take the payout? Well, I say take the lump sum and turn it into a individual IRA, and you got everything solved. But they're not having the conversation, and I think they have to start having the fixed annuity conversation.
My guest has been Kim O'Brien. She is the president and CEO of the National Association for Fixed Annuities. Kim, it is a great pleasure. Thank you so much.
Well, thank you. We appreciate it. Anytime we can talk about fixed annuities, Scott. Thank you.
Well, it just so happens we like to talk about that a lot, Kim. Thank you. This is Annuity News Now. Thanks for watching.